Welcome to the Stock Mirror platform, where we skip the noise and see the signal. Today we're looking at PACE Digitek Limited, which recently released its earnings for the second quarter of financial year 2026. Let's dive into the key highlights. Now, moving to summary. PACE Digitek reported H1 revenue of 900 crore rupees with improved profit after tax, PAT margins of 13.61%. While revenue declined year over year due to business seasonality, the company maintains its full year guidance. Strong order book of 9,135 crore rupees provides visibility for future growth. The BS business is a key growth driver with capacity expansion underway. The company maintains a healthy balance sheet with debt equity of 0.11x and net worth of 1,331 crore rupees. Quick note on revenue growth. H1 revenue was 900 crore rupees versus 1,188 crore rupees year over year, a decline of 24.2%. The company is on track with future guidance of 2,600 to 2,700 crore rupees for financial year 2026 and 3,100 to 3,200 crore rupees for financial year 2027. Reasons include seasonality of the EPC business, with the second half typically contributing two-thirds of annual sales. Brief update on margin change. PAT margin expanded by 82 basis points year over year to 13.61%. The margin change category is expansion, driven by higher margins from project milestones and improved operational efficiencies. Let's jump into market share. Market share status is gain. The company is expanding its presence in the energy storage market with successful project executions and capacity expansion. Order book grew to 9,135 crore rupees with the energy segment dominating the future revenue mix. The company maintains advantage through product control and cost efficiency despite competitive pressures. Zooming into investments. Short-term investments focus on base capacity expansion and backward integration, with 100 crore rupees allocated for an additional 5 GWH facility. Long-term investments focus on energy projects development and market expansion, with 630 crore rupees from the IPO for developer projects. The total order book of 9,135 crore rupees will drive future growth. Next up, outlook. The short-term outlook is positive, with strong order book conversion expected from Q4 of financial year 2026 onwards, targeting 40 BESS site completions by financial year 2026 end. The long-term outlook is very positive, with the energy order book expected to grow to 8,000 to 10,000 crore rupees by financial year 2026 end. The annuity business is projected to generate 420 crore rupees annual revenue with 85% EBITDA margins from financial year 2028. Let's unpack important questions. One key question was about managing working capital for large orders. The answer involves using IPO funds for the equity portion in developer projects, 30%, along with debt financing, 70%, internal accruals, LC limits, and advance payments from EPC contracts. Another question focused on the competitive advantage in the BESS market. The answer highlights product manufacturing control, backward integration, cost advantage through a 5% import duty on cells versus 20% on finished goods, and established supplier relationships. Please check the Stock Mirror platform link in the description below for a detailed view. Thank you for watching our Stock Mirror earning insights. If you found this helpful, please do like, share, and subscribe for more updates.